Yeah, let me know if there is sound. Let me know if there is sound. That was weird. I don't know why that happened. If we're good, I'll keep rolling on. Otherwise, I'll have to pull the plug, I guess. Just waiting for your feedback there. Hopefully, we're good. All right. All right, perfect. Wonderful. All right, so let's just start over back at the beginning. First up, we've got the CBOE 2022 options expiration calendar. If you Google search that title, the very first link should be a PDF to download this calendar. I don't know why I haven't shared this calendar before, but it's important to know because on different colored days, obviously there's a key here that shows you what happens on those colors. But if we look, November 18th, and let me turn my drawing tools on here. November 18th, which is this box right here, okay? It's red, right? So the red key right here would show us that, and let me see if I can read this. I might have to blow it up a little bit here. Just a little bit more. All right. It says standard expiration date for equities, equity index, ETF and ETN options. Equity leaps expire in December, January, and June. So this is just telling you today was just a regular old expiration day for options, which mean that with options expiring, investors have a couple options who are playing options. That was weird. I should have chose a different investors have a few different choices for playing options. But when it's an expiry day, that means the option's going to expire. Sometimes they expire and nothing happens. Other times there can be gains, there can be losses, there can be potential losses that try to get covered real quick at the last moment. So it can be a tricky day in the market. And the biggest thing to really take away from this is that it can lead to volatility. Okay. And I'm going to show you that volatility in just a moment. But I did want to point out a couple of things first on a high level kind of sector things that happened today. So first of all, Palo Alto Networks. Investor sentiment was boosted by a few earnings reports that were better than expected. Palo Alto Networks was one of them. That's the chart that's here in front of you. And they are in the technology sector. Palo Alto was a huge winning standout in the technology sector, up nearly 7% on the day. And if you look at the chart here, over the past quarter, the past actually 2 quarters, the past 6 months, this stock has gone nowhere. This, if you are looking to put your money in a place, park it someplace where it wouldn't lose value, well, you could have parked it in Palo Alto Networks and you'd be about the same as it was 6 months ago. So this thing has just been moving sideways. To me, this chart is telling me this company is holding up during a bear market. And this earnings report in particular, they were able to turn out a profit for the first time. This is really good. Cybersecurity is where they're at. Now, during a recession, sure, companies are going to pull back their spending. Companies are going to, let go of people. There have been announcement after announcement after announcement of companies laying off people. What about cybersecurity? It doesn't matter being a tech firm or any firm at this point because everyone uses tech. It doesn't matter if you have 10 employees or 10,000 employees. You need cybersecurity. So this looks like Palo Alto Networks could be a good choice for a recession. So I'm going to do a deep dive on Palo Alto Networks. I'm going to release the video. It'll be a standalone video this weekend. So be on the lookout for that. Then we had a couple of unexpected pops in the retail sector today. Ross Stores was up nearly 10%. Foot Locker was up 8.7%. They enjoyed some big gains. Why did Ross Stores do so well when Walmart, Target were preaching doom and gloom? Well, Ross is a discount store. Find the word that I was looking for. A discount store. So you can go into Ross, you can find brand name items, but much cheaper. See, a store like Ross, being a discounter, they will go to these big name brands and companies and say, what do you have left over? We'll buy it, but for a discount. And then they resell it, right? That's what a company like Ross is doing. So you could actually do that yourself by going to a Ross store, finding some big name brand type of clothing and shoes and so forth in Ross. And then you could go to Facebook Marketplace or some other online store and you could sell it for a profit yourself. Oh boy. So yeah, that's a little business scheme that you could probably work out on your own there. And then Foot Locker, well known. Yeah, people pay attention to the shoes they wear. Me, not so much. Just give me a pair of Adidas and I'm good to go. So yeah, Foot Locker was a surprise today as well. So there were a couple of interesting earnings reports that didn't go down the tube. Bath and Body Works was another one that did tremendous. It gained like 20% this week. So pretty darn good there. Now, the initial upside, and let's go over here to the SPX real quick. I'm also going to do a deep dive on Applied Materials. They're in the semiconductor space. They're also an interesting company that I think you guys would like. I've done a deep dive on Applied Materials before, much earlier on the channel, for an earnings report too. So I'm going to do them again. I like that company, Applied Materials, but it can get pricey at times. It can become a very popular stock. All right, looking here on the chart. All right, you can see yesterday we had a choppy day. Today, my gosh, look at this. How could you play this? Okay, this was really, really tough. So we have this gap up this morning, right? So this initial upside momentum, it was dampened by a report showing the 9th straight monthly decline in existing home sales, right? When home prices go down, there's the wealth effect, right? People feel less wealthy, they spend less money. And then we also had a 0.8% month-over-month decline in the leading economic index that marked the 8th straight monthly decline for that series as well. So stocks took a turn midday and took it down, I guess a leg lower, you could say, as treasury yields also creeped up and the dollar built up some strength. Remember yesterday, I said one chart out of all that I'm watching is the dollar, ticker symbol DXY. We'll go look at that in a moment. But first, I want to show you this. On the 5-minute chart for the SPX, what I did this morning was I took 2 anchored VWAPs. I attached one. Let me get my highlighter here. I attached one to yesterday's close right here, and I attached the other on this morning's candle. And those are the 2, and let me just darken these black lines up here. There's 2 black lines on the chart. Both of them are the anchored VWAP. So there we go. You can see them a little better now. So I anchored those this morning and I was watching for opportunities, right? Gap up, gap down, it doesn't matter. When there's a gap, put an anchored VWAP on there and watch how price action moves around it. You can see this morning that once that anchor was there, the market starts using it as resistance, right? And then it just kind of played around for a while. And then it found resistance on that upper anchored VWAP again, okay? It wasn't until this afternoon that it broke its structure. It had a change of character, okay? And once it broke through this, it back tested it and then it went off, okay? That would have been a great entry point on that back test or even the breakout of this anchored VWAP. And then, of course, we hit this morning's high or just about there and then sold off. Nobody wants to hold too many open positions over the weekend, right? So that's why we had that big sell-off there at the end. So that could have been a good trade today. I didn't take it. I didn't take any today. It was just too choppy of the day, and there was just like no direction. It didn't matter what you did and what you used. It was a rough day out there. All right, cleaning this chart up, going to the daily view now. And we'll go to the dollar in just a moment. But first, I want to show you the SPX, the SPY, and the Qs. And then we'll go look at the dollar real quick. So basically, all week, right? Let me open this chart up. We really went nowhere. Actually went negative a little bit for the week. And let's pull this up. So the weekly expected moves, they held just perfectly. Finished the week right there, almost smack dab in the middle. But you see today's candle really, really small. And if we're looking for, well, what kind of candle could this be? The closest thing that I would say is a doji. Let's put the candlesticks up here. So you could go spinning top, but really the body wasn't that thick for it to be a spinning top for me. For me, it was right here, a doji candle. That's where I think we fell today as far as what's the candle look like. And basically, we've gone nowhere all week, right? So a choppy week. And also remember, and I show this often with the seasonality pattern here, right? We have the red line, which is for a midterm election year. Hold on one. No, I don't want to close this. I thought I could make it bigger. Oh, that went too far. Okay, maybe messing around with this anyway. Okay. November. So what do we have? We have very volatile, very choppy, and a downward slope to it. Okay. If you apply that to this week, right, in November, what do we have here for the week? Let's go to Monday's candle, which was right here. So if we just draw a line, Monday's candle on the bottom there, and we match the top up, what does that look like to you? What does that look like? That looks just like the November choppiness with a downward slope to it. That's exactly what this week looked like, and that's exactly what November, at least on the seasonality chart, shows us for November. So it's going to be a tough November. It's going to be tough to trade. We also have holiday coming up with Thanksgiving, right? Okay. So next week, what do I expect? More of the same. More of the same, right? I don't think we're going to go too far anywhere. And now let's go look at the SPY. Same structure as the SPX. If we line up the candles, right? Monday, we can put a down slope there to match those up and a down slope there to match those up. And yeah, it looks like we're trading sideways with a bit of a down slope to it, right? So that's what November calls for on the seasonality chart. It's been spot on. Now here we have the Qs. The Qs, same thing. Absolutely same thing. If we go to Monday, just connect those two lower candles with these two higher candles, and we've got downtrend, moving sideways, choppiness all around. Nothing spectacular or fun. Now, one theory that I've heard quite a bit is the head and shoulders here. Okay. Could it be possible that tech or the Qs here have a bit of a head and shoulders pattern for them? My highlighter stopped. A little bit of head and shoulders action going on. Maybe. I don't think so. But I have heard it talked about. The other thing is, what if this choppiness right here is going to lead and end up being a flagging pattern and we get another move up? That's a possibility. I think we're more likely to see a move higher than a move down from where we are on the SPY and the Qs, simply because this market wants to rally badly. And if it does end up being, a flagging pattern, right, where we move up and then we go from expansion, flagging, contraction, and then we break out, well, I just think that's going to set up a bull trap. As we move up here, we're going to get to very stiff resistance up here with the line that stopped every big rally of 2022. And then we get our pullback from that point, and it ends up being a bull trap up here. I think that could be a likely scenario that the market wants to go in. The market doesn't want a bull trap, but I think that if we do happen to move up for some odd reason, we get the momentum, then I think that it could be setting up a bull trap up there. All right, let's put the IWM up here one more time. Haven't put them up yet. And look at this, same pattern. We can do the exact same here. Connect the two bottoms from Monday and then the two tops here. And you could call it a flagging pattern, which means we may have a little more room to go, or we don't, right? And if we do have a little bit more room to go, I don't think the IWM is going to have that much more room to go. It's already close to its pattern, my apologies, to its top from the summer or mid-August top that we had right back here. I got to bring the chart down a little bit to actually see it. Right there. Yes. Let me put that up there. Yes, I do as well. So this top right here, you can see, well, it's tough to see. There's a lot going on up there, but intraday broke above it. But for the IWM here, it closed above this line for one single day before falling back below it. This is tough resistance. The SPY, the SPX, they're almost there, almost to that same down sloping trend line that has stopped every rally so far in 2022. The SPY and SPX, they're almost there. The Q, a little bit further off. IWM, it's sitting on it right now. So could it just be a choppy move, choppy move sideways and down sloping for the SPX over the next couple of weeks? Absolutely. Absolutely, it could. All right, let me go show you the dollar real quick, because it did find a little bit of strength today, but it's still doing its thing, right? The pattern that we drew out yesterday here and showed you, if we adjust it to add today's candle, we've got to bring that top trend line up a little bit, and that bottom trend line, it continues to remain flat. So we still have that same setup here where we're dropping down, okay? We've got a flat bottom, and then we've got a down sloping resistance. Look at that. It looks like a golf club. And if we go to chart patterns, remember I showed you right here the descending triangle, okay? That's where we have the drop down, and then we have the flat bottom and a down sloping top. And these descending triangles, they can break either way. We can either have a breakout to the upside, or we can have a breakdown to the downside, okay? So these are neutral or bilateral patterns. They don't really mean too much, right? Except the fact that it could go either way. Now, its 200-day moving average is getting closer and closer, all right? The more this moves sideways, the closer that 200-day moving average is going to be. And if it continues to move up while the dollar moves sideways, that could end up being a launching pad for the dollar, sending it up higher, okay? So that's why this is the #1 chart that I'm watching. I want to see what this dollar is going to do, because this is going to determine, you know, whether the SPY, SPX, Qs, IWM, whether they're at their top or if they have a little bit more room to go. And then if the dollar decides to break out instead of breaking down, that'll pull the rest of the broader indices down with it. As it pops, the SPY will drop. That's why I'm watching it so carefully. Now, we also had mega caps today, and they contributed to the midday fall, but they eventually found some footing in the late afternoon to help this 0.5% rally in the SPY, the 0.5% rally in the SPX. We got the Dow Jones up 0.4%, the IWM up 0.7%, and the dollar was up 0.3%, which is kind of odd seeing all of them in the green on the same day, since the dollar has such an inverse relationship with the major indices, right? Now, by 2 o'clock, there was some fairly broad-based buying interest. It picked up again, and the major averages were able to close off their session lows. Now, if we think about the sectors here, I haven't actually pulled this up in a couple days, surprisingly. We had a couple of red sectors. 9 of the 11 S&P 500 sectors closed in the green, led by utilities and real estate. XLU, utilities, up 2%. Real estate, XLRE, up 1.3%. That's defensive nature. Why are defensive sectors up the biggest if we're expecting a rally? If we're expecting the market to brush itself off, pick itself up, and rally? Because there's going to be a bull trap if we rally. That's my thought. A bull trap if we end up rallying. Now, the communication services, which is XLC, and energy, XLE, they were the lone holdouts in negative territory. Now, energy fell because of the falling price of oil today. Let's look at oil. We haven't looked at that in a while. U.S. oil. Now, oil fell 2.2% today, but it has a massive, big wick under that falling candle today. So let me clean this chart up just a little bit. I want to take that highlighter off. You can see it broke down through this, but look at this. It tagged this this support area nearly perfectly on the tail of this thing it got down to a low here of 77.24, which is right there, nearly matching this low here. Holding that and bouncing off of it was awesome. And if we go look at our candlestick patterns, all right, when you see, and actually, let me bring this back down. When you see that you are coming down like this in this 3 days of red, and then you have a big wick on that. Let me pull up the candlestick patterns. Go over here to the bullish side. Is this a hammer candle that we're seeing? Where we have the first side concluded. We've got this down sloping negative days, and then we have a candle with a big wick on the bottom. Is this now bullish for oil to rise? Is that what we're looking at here? I think so. I think so. And that's going to help energy to boost itself and have a potentially nice week next week. So let's watch this, keep this on our radar, because energy could be a good play for us next week. So definitely, I think I'm seeing a setup here for oil, and then of course for energy and energy stocks as well. Now, the pullback in oil prices, I think was, or if you go from this top here, right, and then this decline here, I think this decline is mainly market participants continuing to worry about an economic slowdown, right? We had more comments, more Fedspeak today. Boston Fed President Collins, who is a 2022 FOMC voter, piled onto this concern about an economic slowdown. She said in a CNBC interview that the Fed is not done raising rates and that a 75 basis point rate hike in December is still on the table. Now, if we go look, what's the market pricing in? CME Fed Watch tool. What's the market pricing in for an interest rate hike in December? The last time I looked at this earlier today, it was sitting with the majority saying a 50 basis point rate hike at the December meeting. And it's still calling. All right, let's get these pop-ups off of here. All right, so for the December 14th meeting, we have a 75.8% probability of a 50 basis point rate hike, a 24.2% probability of a 75 basis point rate hike. So right now, everyone's looking at a 50 basis point rate hike, okay? So with the Fed coming out and saying that a 75 basis point rate hike is not off the table for the December meeting, they're trying to get this market to slow its roll, slow this rally down, take it down a notch, or the Fed might do it. The Fed might do a 75 basis point rate hike if this market keeps rallying. Just to say, we mean it. We're going to put our foot down. We mean it. All right? Okay. Let's see here. Don't want to miss your comments here. If the Russian war were to end suddenly, do you think energy is a no-brainer short? Yeah. If Russia ends the war, it depends. It depends on what the outcome is going to be, okay? My initial quick thought is yes. But then as I start to think about this a little bit more, if Russia ends the war, Putin does not want to feel humiliated, okay? He wants to feel like he got something from this. He accomplished something. But you add on top of that, and let me see if I can pull this up. Have you heard of the BRICS? Okay. Let's see here. The BRICS nations. Let's see if I can't find a quick chart here. So, with everything that's happened to Russia, okay, and the sanctions placed on Russia, there is a group of nations who are creating what's called BRICS. It's a new currency that is based on commodities, or it's pegged to commodities. Let's see. There's no good chart here that I have found yet. So because of this BRICS currency, BRICS reserve currency, it's Russia, it's China, India, Brazil, and South Africa. I can't remember who else off the top of my head, but those are like the main players of this. And if they do end up competing here with the petrodollar, I think Saudi Arabia this past week or within the past 2 weeks or so has mentioned about joining the BRICS system, and they're going to use the Chinese digital yuan as like the backbone. So these these countries can move their currency around outside of the SWIFT system, which is the United States here. Here, what is this one? And if this ends up becoming a reality, okay, then here, let me bring this over to this screen. Then this may not, oh, come on, may not bring oil prices down all that much, okay? Because this will upset the apple cart and how the world functions. BRICS Plus adds scale. So Russia is part of this, China, India, South Africa, Brazil, Argentina. Those are like the big players in this. It looks like Malaysia, Indonesia, Singapore, Thailand, Bangladesh, Sri Lanka are all part of this BRICS currency, okay? And if this is going to be the deal, okay, and just Saudi Arabia, just right, I can't draw on this. Here, let me. That way I can draw on it. Okay, so Saudi Arabia is like the linchpin of the petrodollar. For the past 50 years, and Saudi Arabia is right here, okay? Saudi Arabia has been the linchpin for the petrodollar, for the dollar being the dominant, the currency used to purchase oil. If this BRICS currency comes to light and it takes off, and it's an actual challenge to the dollar, well, it's going to destroy the value of the dollar. And if Saudi Arabia, who has been with the United States for the past 50 years, okay, and Saudi Arabia has said, if you protect us, we will make sure that oil is sold in US dollar. And that's the main world reserve currency. Now, if Saudi Arabia, which seems to be planning to, instead of being with the United States for the next 50 years, but being with China for the next 50 years, that will be no good for the US dollar being the world reserve currency, especially in the oil market. So this is something that I have to think about too, because if the war with Russia and Ukraine up here, if that ends with Russia saying, fine, we'll keep what we've conquered over here on the eastern side of Ukraine, and Ukraine can have the rest, but we're going to join this BRICS monetary system and no more to the dollar, which is pretty much how Russia is right now because, all the sanctions and whatnot. This would be devastating, and it may not drive the price of oil down as much as one might think. Okay? So that's something to keep in mind too. I know it's something new. I know it's something that may not happen. And if the war were to end, like tomorrow, and this BRICS monetary system isn't launched at or around the same time, then yes, the price of oil could go down dramatically. However, if Russia ends the war and this BRICS monetary system is either coming out near the same time or even before Russia ends the war, and oil is a commodity, and they're pegging their currency to the price of commodities, then I don't think oil would drop so suddenly. So I'm trying to think of all the puzzle pieces here that could come into play. Now, if this BRICS thing is nowhere in sight, even though it's building up a lot of steam right now, and Russia were to end it tomorrow, just suddenly pull out, we're not doing it anymore, then oil would probably drop significantly. But it's this BRICS monetary system that has me a little unsure, uncertain. It's providing a bit of FUD, even in my mind, a little bit of fear, uncertainty, and doubt. Because the dollar for the last 50 plus years hasn't had any competitors, okay? But if this BRIC system ends up competing, then the dollar, good old DXY here, this dollar is going to drop hard if it has a real challenge, okay? Because remember, a strong dollar hurts other countries. A weak dollar helps other countries. So the whole job of that BRICS monetary system, Google it, look it up, do a little surface research on it, learn about it. It's very interesting. However, if that BRICS monetary system does come into play, something that's going to skyrocket is gold. Gold will just go through the roof. So because that's out there, just to play hypothetical, if Russia pulled out and stopped the war and the BRICS system is nowhere in sight, oil drops. If the BRICS system is there challenging the dollar and then Russia pulls out, I don't think oil is going to fall at all. Since they're pegging their currency to commodities, then higher commodity prices are better for their currency. And stable commodity prices actually work in their benefit. And, commodity prices, they can be very volatile and fluctuate. So something interesting, if you've heard about it before, sorry for repeating it. I'm still learning about it, so I don't have a lot to say on it. But your question does make me think of that, because Russia being cut off from basically the West right now has to find partners and allies somewhere. And China seems to be a big partner or potential partner with Russia right now. And if they're building an alternative currency to the West that will compete with the West, that could be dangerous. So the short answer is, yeah, oil could drop. The longer answer is you have to take into account this whole BRICS monetary policy, or the BRICS currency, however they're going to end up naming it. So, okay, cool. Yeah, it's interesting. It's very interesting. Okay, let's see here. I guess that was everything. It is a Friday evening, so I don't want to keep you too long here. Do you guys have any other questions? If you do, go ahead, plug them in. Let's see here. Did I cover everything that I wanted to? Let's see here. For our investor community, we do have a big picture article coming out tomorrow on Saturday. So look for that. We're going to talk about some earnings, big picture view of the market. It'll be very interesting. Oh, one other thing I did want to talk about, and let's go to XHB, which is the Home Builder Index or Home Builder ETF, because we did get existing home sales data today, and it dropped again, this time 5.9% month over month in October. And that works out to a seasonally adjusted annual rate of 4.43 million, where the expectation was 4.38 million. So really not far off from expectations. Now, the September report had us at 4.71 million. So a pretty significant drop from the previous month. Now, this is the 9th straight month in a row that existing home sales have fallen. and it is the weakest pace of sales since late 2011, excluding, of course, the 2020 pandemic period when housing pretty much stalled before it skyrocketed. Now, total sales in October were down 28.4% from a year ago. That's a big deal. Prices are going to start falling faster and faster and faster as time moves forward. So it's not a good thing. I guess the key thing to take away from this is that the higher mortgage rates are taking a big bite out of existing home sales. And of course, it's created affordability pressures for prospective buyers and deferred listing decisions for potential sellers. Because you sell your home, where are you going to go next, right? They see a very expensive repurchase proposition. And the housing market is just steadily crumbling. I am surprised the home builder index or ETF has been able to hold up as well as it has over the past couple of weeks. I guess the only other thing to mention is that there's no real economic data on Monday, but there are some earnings reports on Monday, and that's it. Bitcoin, I need it to drop. Well, right now, some of you probably remember, but I used to have a box on here for where I thought Bitcoin might hold up, right? And it was 16,500 up to about $20,000. That's where I had a box, and I said this could be a good area for a base to build for Bitcoin. The one thing that I find interesting is this purple trend line that's coming down here, right? Well, when Bitcoin was moving sideways, it broke through that trend line. But when it dropped, it fell right to that trend line, and it's just been marching sideways ever since. Just marching sideways. Not moving a whole lot. Also, let's see here. Let's put this up here on the screen as I raise this up for Bitcoin. Why is deflation dangerous? I hear some people say it is. That's my last question. Okay. All right. So why is deflation a problem? All right. The Fed needs price stability. That's the Fed's number 2 job, or number 1 job. Full employment and price stability. That's the Fed's job. And they use monetary policy to help keep employment full and price balanced. Well, over the pandemic, prices skyrocketed for all kinds of things because there was no demand and then there was a big demand, right? So inflation, a few months later, maybe a year later, starts creeping up and inflation gets really high. So what does the Fed have in its toolbox to fight inflation? It can tighten. It can go from quantitative easing, which during the pandemic in 2020, the Fed was at unlimited quantitative easing, meaning the Fed was going to print as much money as they wanted, and they were going to buy as much as they wanted to keep prices stable, to keep full employment. Well, when the government prints money, inflation is always the next thing to come. Always. When the government spends too much money, the next thing to come is always inflation. Inflation is actually a very key tool for the government to use to lower its debt burden, surprisingly enough. Now, the Fed can also raise interest rates. And the whole point of raising interest rates is making it more expensive to borrow money, meaning consumers won't borrow as much money, businesses won't borrow as much money, meaning businesses can't expand. They have to contract during this period. Now, if the Fed overdoes this, if the Fed over tightens, meaning taking money out of the market, and if the Fed raises interest rates too high, going too fast, too far, just like a stock chart. When you see a stock that has gone up too fast and too far, what does it need to do? It needs to pull back, reconnect with that 5-day EMA. Same thing with inflation. When the Fed tightens, when the Fed raises rates, inflation comes down. Right now, since inflation is coming down little by little, we are in a disinflation environment, technically. If we get to a point where inflation is going below that 2% target rate, then we are in a deflation environment. Deflation is just as bad, if not worse, as inflation itself, because price stability is what you want. If prices tank, companies go out of business. That's one of the biggest worries about deflation, okay? Deflation means companies are shutting its doors, laying off workers. Where do these workers go to get jobs? They can't. Now the next company closes its doors. So deflation is a big risk to the economy, just like inflation is, all right? We want price stability. Right at that zero line would be wonderful, but we all know inflation never stays down there. So that's why the Fed has the 2% target rate for inflation. If every year inflation is going up by 2%, the Fed says that's good price stability. So think of the swinging pendulum, right? We've got inflation on one side, deflation on the other side. When you're driving a car, you want your tires to be inflated. It runs great. Not a good analogy for inflation, but the analogy for the difference between inflation and deflation. Now, go deflate your tires. Take all the air out of it. Now try to drive. How's that ride? Is it okay? No, it's not. You're riding on your rims. You're not going to get very far. So the swing of the pendulum, inflation, deflation, both of them are harmful. Inflation is more harmful to the consumer. Deflation is more harmful to companies, to business. That's the easiest way that I know to put it, without making it complicated and sounding like you need some kind of a finance degree or be some type of world-renowned economist to talk about inflation and deflation. So just think of that swinging pendulum, think of price stability, and think of riding in your car and I guess I should add with that car analogy to give you the difference. Inflation, your tires are pumped up to as much air as they could possibly hold, right? So they're extra, extra wide. It's like a balloon that's about to pop, versus deflation when all the air has been taken out of your tires. You want that price stability. You want the perfect amount of air in your tires so your vehicle can run along on the road and be as smooth as I don't know what. That's the biggest difference. Consumer pain, inflation, business pain, which can lead to consumer pain on deflation. That's why I say deflation is as bad as, if not worse than, inflation. Okay. I hope that helped. Let me know if that helped at all. If not, we can try to take a different route with it. But I think that's the easiest way to look at it. All right. Well, we'll wrap it up here for tonight. Let's do that right quick. All right. So if you guys could just click that like. All right. Perfect. Wonderful. Click that like button for me. Share this video with a friend. Those two things greatly help out. And I should have the Stay in the Loop video, Palo Alto Networks, Applied Materials out this weekend for you. And also our investor community. Big picture view of the economy coming out tomorrow. And then Sunday evening, weekly expected moves. Over 40 some products now. If you want a product included, just let me know. I'll include it in the weekly expected move. With that said, I'll be back Monday after the market has closed to talk about what happened, why it happened, and what to expect moving forward. So thank you so very much for joining me today. I greatly appreciate it. Have a wonderful weekend, and I'll see you in the next video. Take care.